Transferring wealth successfully starts with asking yourself questions that will give your family a better life now and for generations to come. In this podcast, financial professionals John and Michael from Copper Beech Financial Group guide you through eye-opening questions to help you discover the truth about your wealth. Now, on to the show.
Hello and welcome to The Truth About Wealth with John and Michael Parise of Copper Beech Financial Group. Today, Michael is flying solo. John is out doing something. Well, I'll just let Michael explain that here in a minute. But I'm excited because we have a guest on the show, and that is Darren Sugiyama. Michael, I know you brought Darren on because he is fantastic and you guys have done work together. Why don't you give us the lowdown on what's going on today?
Sure. Well, the lowdown on where my father is we had some thunderstorms roll through here, and he is at the office on our setup there at the office, and the power went out. So
sitting in the dark.
He is unable to make it today, so I will be flying solo.
All right.
But Darren, yes, we've been working with Darren for a good number of years now. Darren is a graduate of Loyola Marymount University, where he was a team captain of the baseball team and completed his master's degree in multicultural education from the University of Hawaii. He's also the author of the internationally acclaimed book, How I Built a $37 million insurance agency in less than 7 years, and has also authored 3 additional books, including Ouch! My Financial Advisor Lost Me $930,000 in 3 years. So that's a pretty provocative title, Darren.
Yeah.
But his background is in building successful insurance agencies and developing creative insurance-based solutions. And in the early 2000s, he was responsible for developing self-funded deductible plans in the small group employee benefits world, which is a cutting-edge approach to an otherwise commoditized market. His contribution to the industry led him to build his startup agency into the number 1 brokerage firm in the county with Kaiser Permanente, number 1 in the country with Health Net, and number 2 in the state of California with Aetna, number 1 in Orange County, California with Blue Shield, and to name a few of his accolades in the insurance industry. In 2016, Darren launched a proprietary employee benefits retirement group that he co-developed with Pacific Life. In 2017, his program was responsible for over 25% of Pacific Life's policy count in Orange County, California. Darren's gift is demystifying the confusion of the industry and approaches his clients at Lionsmark Capital with a mathematically based, zero-nonsense, blunt candor that is unique and refreshing. So, Darren, thank you very much for being here today.
Oh, pleasure. Thank you for having me.
Well, we wanted to have you on, Darren, because the topic we're going to talk about today is what a lot of our families consider a unique concept that they really haven't heard of before, and that's going to be premium financing of life insurance policies. And that's really what Lionsmark Capital, what you've built it to really specialize in. So that's what we're going to be talking about today. But to start off, because this tends to be a unique and sometimes foreign concept for a lot of our families, can you just start and explain what premium financing is?
Sure. There's 2 different types of clients we have that are looking for 2 very different outcomes. The first group would be folks that are buying life insurance primarily for the death benefit. Think of it as buying a life insurance policy in a similar fashion that you would buy a house with a mortgage. So these folks are buying very large life insurance policies. They are borrowing the money from a bank to fund the premiums, and then they're paying interest on those borrowed funds, again, in this very similar way that you would buy a house with a mortgage. The second group of people are buying a life insurance policy more so for the cash accumulation aspect. So they're buying it as an asset class, something that has historically has returns equal to the equities markets, but with the de-risking factors of, say, like a bond portfolio. So it's a very safe, a very conservative way to build wealth over time, as well as a way to protect your family in the event of a premature death.
Yeah, I think you hit the nail on the head with the analogy of buying a house. And so the way we've approached premium financing with a lot of our families is when you make a major purchase of anything, whether that be a house or another piece of real estate or a business or a car, typically financing is involved in that. And really, if you have an insurance need, one of those needs that you just mentioned, Darren, you can, in addition to either paying some money out of pocket or another way of funding it, you can use a bank, just like you would buying a piece of real estate, to assist you in purchasing that policy that you would otherwise need. So I think that's a great analogy, because the real estate is a common example where a lot of the families, they understand, okay, if I'm going to buy a piece of real estate, I'm going to put a little bit of money down and I'm going to have a bank assist me in the remainder of that purchase. It's the same thing that we're talking about here. So I really appreciate that analogy. But where does premium financing fit? Are there particular a class of purchasers? Is there a requirement that a purchaser needs to meet in order to utilize this program?
Yeah, that's a great question. It depends primarily on the person's net worth. So certain insurance companies will have certain requirements, parameters in terms of a minimum net worth requirement. Typically, that minimum net worth requirement is $5 million. We do have some really special and proprietary programs that we've gotten approved with a couple other different insurance carriers that will allow us to do this with folks that have a net worth sub $2.5 million. And one of them will actually allow us to do this for clients that have a net worth sub $500,000. So it really comes down to being responsible on our side as the advisor, having that fiduciary responsibility over understanding what the client's needs are, what the client's budget is, what their ability to maintain that budget over a period of time is relative to their type of business, the type of industry they're in, and then really matching up the right client with the right strategy. If you go back to, I alluded to buying a home with a mortgage, right, as kind of an analogy to doing this with a life insurance policy. If we go back to pre-mortgage crisis, 2007, 2008, you had a lot of abusive mortgage loans out there that were not suitable for the clients, that were far over leveraged, and they got the wrong people into the wrong mortgage loans, and we know what happened with all of that. I'd say the danger in premium financing in current times is that you have a lot of firms out there that are essentially doing something very similar to what these mortgage lenders were doing back just prior to the mortgage crash. In the mortgage industry, you had these folks engaging in these negative amortization loans, which were very risky, and you could argue were appropriate for a wealthy client that had a huge risk tolerance and a lot of liquidity. But as we all know, a lot of folks got into those mortgage loans without really understanding how they worked. And in the end, they paid the price for it. In premium financing, we like to use the term responsible leverage. So again, it's getting the right client into the right program, something that makes sense for the client short term as well as long term, taking into consideration all of the unknowns of the future. Market crashes, volatility, poor sequence of returns, et cetera, et cetera. And that's why we love working with Copper Beech, because I know you folks do such a great job of doing the right thing for the client from an ethical and a fiduciary responsibility standpoint.
Yeah, you brought up a great point, Darren. And if anyone who's listening, maybe after this podcast, wants to look up premium financing, whether it's on Google, I would advise you to go to Darren's website, lionsmarkcapital.com, and check out some of the videos that he's put up on the website. They're really great. They're a great primer on introducing this concept of premium financing. But you brought up a really interesting point, Darren, because we see that a lot on our end as well in terms of how this concept of premium financing is frankly introduced to the client. And there have been times we've heard clients say, I've been introduced to premium financing in the past. It's like free insurance, right? I can borrow all the premiums from a bank for this insurance policy that maybe I don't even need, but it's nice if I can get it for free, right? That's not how this works. I believe you would agree with that. So with that in mind, can you walk through a little bit of sort of the structure of, let's say, a typical premium financing loan, what that would look like? What are the variables that go into that type of loan? Because anytime you talk about borrowing any kind of money for any purchase, there's always the question of how that loan is structured and how it works. So can you walk through a little bit of how a typical premium financing arrangement would work?
Sure. The typical trepidation and concerns that folks have when they look at the concept of premium financing, quite frankly, a lot of their concerns are very valid if they're looking at what we would call a traditional premium financing setup. So I'll walk through what that looks like, and then I'll walk through what we do that is substantially different. The general concept is that the client is going to borrow premiums. So I'll use round numbers here. Right? So let's say the client was going to borrow $100,000 a year in life insurance premium, and they're going to borrow that $100,000 per year each year over a period of, say, 7 years or 10 years. We'll just use 10 to make the math easier. So they would essentially be borrowing $1 million over the course of that 10 years. Each year they would be paying the interest on the loan balance. So in year one, they'd pay the interest on $100,000. Year two, they'd pay the interest on $200,000 because they would be borrowing yet another $100,000 in year two, et cetera, all the way until they get up to 10 years. Now they've borrowed a total of $1 million, and they're paying interest on that $1 million, and they continue to do that until they decide to pay the third-party lender off. Typically, in a traditional premium financing setup, they would pay off the third-party lender after about 15 years, and they would typically plan to pay that third-party lender off with the increase in cash value in the policy as it is accumulated over that, say, 15-year period. So the idea here, the benefit for the client, is that they're loading a much larger amount of premium into the policy, so they capitalize off of the compounding interest off that larger amount that's loaded in the first 10 years to the point where there's enough excess cash value after, say, 15 years to pull out some of the gains, pay off the third-party lender, and now you've got a much larger, much more robust, a lot more valuable cash value life insurance policy at that point than had you put in the premium out of your own pocket that would equal the interest payments. That's the general idea. There are several challenges that come with that setup, and that doesn't make the setup a bad setup. There are just some issues that you have to be aware of when you enter that type of relationship. So one of them is going to be collateral. And I know a lot of firms out there, they don't, in my estimation, they don't do a thorough enough job of articulating what that collateral means and looks like. So, for example, the client's going to borrow, say, $100,000 in year one. There are charges associated with that life insurance policy, and they're not cheap in the very beginning. They drastically taper off after you get outside the first 10-year window. But in the beginning, they're relatively high because if $100,000 goes into the policy and the client dies in a car accident the next day, that insurance company is on the hook to pay out millions of dollars in life insurance claims, right? So there's going to be some charges there. What happens is if the client's going to borrow, put yourself in the role of the bank. If you're going to loan someone $100,000 to go into a life insurance policy, and after the charges are taken out in that first year, let's say there's only, say, $40,000 worth of account value, but the outstanding loan balance is $100,000. That means there's a $60,000 shortfall, right? That's the gap. So the gap collateral, as they call it, the bank is going to require that the client post a little bit more than $60,000 in gap collateral. Now, as time goes on, say over the first, say, 5 years, the client is borrowing more and more premium, and so that gap collateral requirement is going to increase a little bit more. Now, that's all assuming that the life insurance policy yields a certain percentage of return. So let's say the expectation is the life insurance policy is going to perform at, say, 6% per year. Well, if we have a year that looks like we're having right now, you're not going to get 6%. And so the cash value after that year could be less than what was initially expected, which is going to increase that gap collateral requirement. So there's nothing worse than a client gets into a situation that they don't fully understand, or they don't remember the fact that that collateral requirement might increase. And now the advisor has to go to that client and say, hey, we're going to need you to post an extra 50 grand, 100 grand, $500,000 this year because the policy did not perform as expected. There's nothing wrong or unethical with that situation. Anyone that understands banking and loans understands that loan needs to be collateralized, but it just gives the client one more layer of complexity, one more layer of uncertainty of what's going to happen. So if the policy doesn't perform as expected, the collateral amount is going to increase. And again, now that client's going to get hit with that additional collateral call. What we do is very different. We have the client put a little bit more skin in the game. So again, going back to the mortgage analogy, we're having the client put a little bit larger down payment so that their mortgage payment is a little bit less, but they have a little bit more equity in the asset. In this case, it's the life insurance policy. In the mortgage analogy, obviously, it's the piece of real estate. So what happens now is if, God forbid, we have a market crash and the policy's cash value doesn't get a 5% or 6% or 7% return in that given year, there is enough equity in the policy to suffice to satisfy the collateral requirement that the bank has. So in other words, if the policy value was always in a position where the value of the policy is greater than the outstanding loan balance, the policy can serve as the sole collateral. So in our program, we built an algorithm that will tell us the perfect amount of borrowed premium going into the policy versus the perfect amount of equity premium or out-of-pocket premium going into the policy, so that additional collateral requirement never gets triggered. So I had a CPA recently ask me, well, in your design, what has to happen in order for the client to be required to post collateral outside of the policy or in addition to the policy? We ran our stress test in our proprietary software, which makes us very unique in the space. No one else has the ability to do this. So I started putting in zero after zero after zero. The design required 8 policy 0 credits in a row in the first 8 years of the policy to require the client to have to post additional collateral outside of the policy. In other words, the S&P 500 would have to have negative returns 8 years in a row in the first 8 years of the policy in order for that to happen. Now, in the history of the S&P 500, the most zeros we've ever had, or the most negative return years we've ever had in a row is 3. Which is the year 2000, 2001, and 2002 in recent history. So again, we're using responsible leverage by making sure that the client has as few variables and few surprises as possible. That gives them the certainty they need to move forward, and it gives the CPA the certainty they need to feel comfortable with putting the client into this type of program.
Yeah, that's great. And that's one of the reasons why we really like working with you in Lionsmark Capital, because to your point, there are complexities that are built into this arrangement. And why I mentioned earlier free insurance is because a lot of advisors or promoters of premium financing were frankly going out to clients and telling them, you don't have to put any money down into this policy, or you can only pay the interest on this policy. And because the policy is going to appreciate at this, let's say, inflated or artificially inflated rate of return, which is just an assumption that the advisor is using, then you don't have to post any outside collateral because the policy is going to satisfy the lender of that full loan, which, you know, could be the case. To your point, that's nothing unethical or wrong with that. It's just another variable that has to be managed. So I really appreciate you talking about that, because I think that's a really, really key thing, especially when you're going into an arrangement which could be for 10 or 15 years, as you mentioned earlier. From a lending standpoint, it's important that the clients understand how that's going to be structured and the risks and benefits that are associated with this type of program. But with all that in mind, I wanted you to go, if you can, Darren, go back to the two sort of the two ways in which clients typically like to look at this type of structure. So where does the benefit lie? If let's say I'm a business owner and I need a death benefit maybe to fund my buy-sell agreement, as an example, how can this financing arrangement help me in my business in terms of managing cash flow and help, as opposed to me paying the premium out of pocket?
Sure, that's a great question. Let's go through maybe start out by going through the different ways that someone might fund a buy-sell agreement. I have talked to so many business owners and several CPAs, quite frankly, that say, well, let's just buy cheap term, right? It's the cheapest way to buy the largest amount of death benefit. And just by definition, in theory, it accomplishes the goal, right? Least amount of expense, greatest amount of death benefit to satisfy the buy-sell. Makes sense on the surface. The challenge is that it's like renting an apartment, right? If real estate, if the goal was to have the same square footage in the same neighborhood for the cheapest out of pocket, then everyone would just rent properties, right? No one would ever buy. Well, clearly the reason why people buy real estate, not only is there a pride of ownership, but the hope is that over time, as you own that asset would increase in value. And at the end of the point where you don't need that particular asset anymore, you have a value, right? Meaning a dollar value that you could put in your pocket through selling that asset or whatever it may be. So instead of doing term, what some folks will do is they will spend more premium to get the same amount of death benefit to satisfy the buy-sell agreement, because they know at the end of the rainbow, when they sell the company or they depart or whatever, they now have an asset that has a greatly appreciated value, a tax-free appreciated value, that they can walk away with and use that cash value to semi-fund their own retirement, right? So at least they're not walking away with nothing that they would in a term insurance situation. If we go one level deeper, that's where premium financing comes in. So we say, okay, if you don't want to flush money down the toilet and rent the insurance through the term policy, if you want an asset, then the question is, how do you get the biggest bang for your buck, right? How do you get the greatest benefit for the least out-of-pocket expense? Well, it's very similar to if you have a certain dollar amount in your pocket. If you're going to buy a house and you're going to buy that house with cash versus buy that house through a mortgage, for the same out-of-pocket expense, you're going to be able to buy a much more valuable house if you finance it, right? If you buy that house with a mortgage, than you would if you bought that house cash. Same thing if you're going to finance the premiums of a life insurance policy. So you could either, by using a program like ours, you could either purchase a much larger policy with a much larger death benefit that would ultimately have a much larger amount of cash value to use for your own benefit when you sell the company, for the same out-of-pocket expense, right, meaning the interest payments, than you would if you did not finance a policy. If you just bought the policy with cash, for the same amount of death benefit, you're going to pay a lot more, or you're going to pay the same for a lot smaller life insurance policy.
Yeah, Darren, all of that was really, really, really helpful. We've seen on our end, as you mentioned, particularly for business owners, a lot of our clients that are business owners, and they're always very concerned about cash flow. And so if they have that need, let's in this example, to maybe fund a buy-sell agreement, to fund their shareholder agreement, and they don't want to buy term, as you mentioned. They want to buy a permanent policy because they want that flexibility. But maybe they have other cash flow needs within their business that they want to allocate that cash to. I'm assuming financing can come into play pretty healthily there in terms of helping them with that need, correct?
Yeah, absolutely. I mean, the grand irony with premium financing is that it feels like such a foreign concept to so many people when they first get exposed to it. So what I tried to help them understand is that it's not a foreign concept. It's just it's a foreign concept when it comes to your life insurance, because almost every business owner to some degree has used leverage, right? They've used bank capital to fund something to get a little bit of a head start. If you go back to their education, right? Most people finance their education. through the student loan, right? If you had to pay the full tuition out of pocket in cash every year, you'd probably only be able to afford maybe 2 units a semester, right? It's very expensive. So we use a student loans to finance our education, to get it done in 4 years instead of 24 years. When the business owner first starts their business, oftentimes they'll use lender capital to fund the startup of their business, or to buy inventory, or they use factoring or something like that. So most folks have used leverage to a certain degree before, and certainly if they own a house, the majority of people bought their house using a mortgage loan. So leverage and utilizing bank capital to make something happen in a shorter window of time is nothing new, especially to an entrepreneur. So when it comes to premium financing, though it sounds foreign, the concept is really not foreign. It's something that they have been very comfortable with and have implemented in several different areas of their personal life and their business life for years. So once they begin to understand that, then it's a question of, okay, well, why isn't everyone doing this? Right? That's probably the biggest question I get. If it's so great, why isn't everyone doing this? The answer is very simple and very logical. Premium financing, the target client for premium financing over the last 30 years has typically been for folks that have a $20, $25 million net worth and up. If you talk to folks that have a $50 million net worth and up, and certainly a $100 million net worth and up, they're all very familiar with premium financing. CPAs and estate tax attorneys that deal with that level of net worth of client are very familiar with premium financing. But when you drop down below the $20 million net worth threshold, the familiarity with premium financing drops off a cliff. And so especially when you're dealing with folks that say have a net worth of sub 10 million or sub 5 million, the familiarity is just not there, because premium financing was really built for, what I would call uber wealthy folks, decamillionaires and up. When we are able to expose something programmed to someone that would typically not qualify from a net worth standpoint, they should really be jumping for joy and grateful and thankful that they're exposed to this, because this is really not something that was built for someone at their net worth level. Now, you have to be careful. I have to be careful when I make that statement, because it sounds very exclusionary. It sounds very it sounds like we're a bunch of guys sitting around at the country club sipping $22 cocktails with our little pinkies up in the air saying, So to be able to give access to folks that have done well financially but just don't have that net worth, I think giving them that access is a really great thing for everyone involved.
That actually, I think, is a good segue into when we started, that second reason why a lot of families will look at your program and premium financing in general, and that has to do with maybe using it more as an asset. Like a lot of our families, when we look at life insurance as a component of their planning, there are very few areas where you can accumulate wealth tax-free. One of those is in a retirement account, but in those types of accounts, like qualified accounts, 401k plans, IRA accounts, Roth accounts, they may all grow tax-free and have some good tax advantages, but they're restricted. You're capped at how much you can contribute on an annual basis, or you can't take it out and use it whenever you want. So a lot of our families that want additional flexibility look at life insurance as an asset class, because it's one of the other assets that you can own or accumulate wealth tax-free and take it out tax-free. A lot of our families will use that as a way to supplement some of their other retirement benefits that they've maybe put aside elsewhere. So can you talk a little bit around how maybe your program would assist that type of client in using a life insurance policy?
Absolutely. Again, I think the easiest way for someone that is not familiar with premium financing to get comfortable with it is if we break it down into all the elements that go into the construction of a premium finance life insurance policy. If we can understand each element, it helps the person understand the strategy in its entirety. So let's break down the elements. The first one being the actual life insurance policy. All right, so we're using after-tax dollars going into the life insurance policy. They get the tax deferred growth through while the cash is in the policy, and when they pull the money out, they're pulling the money out tax-free. Exact same treatment, tax treatment as a Roth IRA, right? So when people say, "Well, it sounds too good to be true," well, come on, it's the same thing as the Roth IRA. The Roth IRA gets the same tax treatment as a cash value life insurance policy. So let's start there. Once they accept that and they understand the connection between the tax treatments in both of those vehicles, they say, okay, now I understand that, I accept that, but why would a bank lend premium on this? Because you can't exactly go borrow money from Wells Fargo and then invest that in a bunch of mutual funds, right, with no collateral, right? Why would they do this? That leads us to the second component of this, and that is the crediting method of the policy. So if we're going to use an indexed universal life policy, that is typically going to have a crediting method that's correlated with an index. For example, the S&P 500. Typically, you're going to have a floor and you're going to have a cap. Typically, that floor is going to be 0%, and the cap is going to be somewhere between, say, 8.5% to 12.5%. We'll just use 10, make it an easy number. So let's say I have a 0% floor, 10% cap. What that means is that the S&P returns a negative return in a given year. The client is protected with a 0% floor, meaning that if the S&P takes 30%, they don't lose 30% of their account value that they would in, say, a mutual fund. They lose zero. Now, there's no free lunch, so what they're giving up is some of the upside to give them that downside protection. So if the S&P is up 30%, they're going to get capped at whatever the cap is. So if the cap is 10, the maximum they can earn in a given year is 10%, but they're never going to lose any money because they have the 0% floor. So if you put yourself in the bank's scenario, the bank looks at it and says, well, you mean to tell me that if we loan this guy money and they put the money into an indexed universal life insurance policy that has a 0% floor, that policy value is constructed to where the cash value, the value of the asset, which essentially is the sole collateral in this case, if the value of the asset is always going to be in a position that is greater than the outstanding loan amount, my God, for the bank, that's a great loan. Right. So again, to go back to the mortgage analogy, if you were a bank and you were going to loan someone $1 million to buy $1 million house, you better cross your fingers and hope the value of that house doesn't go below $1 million. If that $1 million house is now worth $700,000 and your lending client decides they're not going to make their mortgage payment, now you're stuck with an asset that's worth $700,000, but your $1 million is still gone. Right. That's a much riskier loan than a premium financing loan in our program. So when people say, well, how risky is premium financing? Well, it sure is a heck of a lot less risky than a mortgage loan for the lender. So once they understand that, it's like, okay, well, geez, this is a very conservative loan. The asset, the policy, is a very de-risked type of asset because of that 0% floor. And God forbid something happens between now and like 5 minutes from now, and I died in a car accident, my family now gets this huge windfall of the death benefit. So even if they're not doing this for the death benefit, if they're purely doing this as an asset class, as part of their overall investment portfolio, either way, it's a heck of an outcome for the client or their beneficiary if, God forbid, something bad happens. So then that begs the question, okay, I understand the leverage piece. I understand why the bank would do it. I understand the tax treatment. I understand the construction of the crediting method with the insurance carrier. Now the question is this better than or worse than a 401k or a standard IRA or a pension plan or whatever? Mm-hmm. So what our firm decided to do is we built a proprietary in-house software program where we can model truly back-tested periods of time of the S&P 500 and show them side by side what would have happened had they put that, say, $100,000 into the life insurance policy, $100,000 out of their own pocket. What would happen if we used several hundreds of thousands or millions of dollars of borrowed money from the bank, where the client's outlay of interest payment was the same $100,000 as if they just paid the premium themselves in a smaller policy, versus what would happen if they invested that $100,000 in, say, mutual funds, versus what would have happened had they invested, say, $180,000 or whatever the pre-tax equivalent of that $100,000 would be into a defined benefit plan or a pension plan where they could put away pre-tax money.
Right.
And we model all of those different scenarios side by side so that we're not trying to sell or convince a client that our program is so much greater than everyone else's. We are saying objectively, here's what would have happened through all these different historical periods of time had you put that same dollar amount in this vehicle versus this vehicle versus this vehicle versus this vehicle. When all is said and done, if our program has mathematically produced a better outcome than all of these other opportunities, what are we arguing about, right? I want to show the client quantitatively what their best option is in a variety of different historical look-back periods, and have them make their decision based off of mathematics, not emotions. When they're able to do that, that's what gives our clients certainty that they're making the right decision, because we have mathematically modeled and proven that this construction works better than this one versus this one versus this one. And that's really what makes us different.
Yeah, and just to add to that, unfortunately, we're running a little low on time, Darren. I want to thank you for coming on, because this has been really enlightening for me, and I know for our listeners as well. But to add to that, and if you look at some of those comparisons that you just mentioned, Darren, and again, what we do at Copper Beech, and our listeners, if you've been listening, you know our role as that family CFO. But when we look at a family holistically, and we look at how, as an example, this life insurance policy could be used within the family's plan, you brought up a lot of those different reasons, Darren. It could be a death benefit need for the family. It could also be used as an asset down the road to supplement the retirement benefit. That could, in fact, be mathematically or quantitatively, as you put it, more advantageous than perhaps what the family's doing otherwise or doing currently. So when you tie all that together, it's really important to look at, this isn't a strategy that you do solely in a vacuum. There has to be a plan behind it. There has to be a good reason for utilizing this structure. And when it fits well, it's a very, very, very powerful tool. And a lot of our families that have worked with you have really enjoyed the results of that. And again, I would like to point out, anyone listening, please go to Darren's website at lionsmarkcapital.com, because he has a lot of really, really good videos that really walk through this program again. But obviously there's some visuals there that I think are really helpful as well. So I really would encourage everyone to do that. Before we sign off, Darren, are there any last minute thoughts that we didn't cover? Anything that you want to let our audience know about premium financing in general?
Yeah, just to dovetail off of what you just said, by no means are we saying that someone should take 100% of their assets and put it into a premium finance life insurance policy.
Absolutely, yeah.
They've got several other goals and initiatives that they want to put in play, short term, midterm, and long term, and so this is a piece of their overall portfolio. I will end with this: when someone says, "Well, what's the max I can put into this?" Which is, we get that question quite a bit. The only real limitation, assuming that the person qualifies and all that preliminary vetting stuff, assuming it's all good to go, the only real limiting factor is going to be the insurability of the person. So in other words, if you're worth $5 million, an insurance company will probably not insure you for $20 million. If you have a $20 million net worth, the insurance company is probably not going to insure you for $100 million, and et cetera, et cetera.
Right.
So what we do when we work with our clients, and certainly when we work with Copper Beech and their clients, we look to see, okay, holistically, what is the overall goal? How does this piece fit into their overall portfolio? And then it's a matter of how much insurance can we talk the insurance company into issuing on that individual client based off of their budget. So we start with the budget. We also look at the life insurance need, and then if the client wants to contribute more money into the strategy, that pushes the death benefit up. Then we go to our relationships with the insurance companies, and we essentially try to justify why that client should deserve a higher death benefit or should qualify for a higher death benefit. So all of those things together make up our relationship and really define our relationship with the clients as well as our relationship with Copper Beech. And we're just really ecstatic about working with the folks at Copper Beech. They do a fantastic job. Michael included, by the way.
Yeah, that's because my dad's not on. That's why you said that, right? No, well, Darren, thank you again. This has been great. I hope everyone listening enjoyed this podcast. I think it's a really, really powerful tool, and hopefully we can have you on again, because I think that this is going to be a popular one, and I'd love to pick your brain on some other options here. But this has been great. Thank you so much.
Great. I welcome the opportunity. Thanks for having me.
Darren and Michael, this was a fantastic podcast. Darren, I know that you've been working with Copper Beech for quite some time. I have had the pleasure of working with them on their podcast and just being here with them, learning so much. And I love the fact that you said it best. I think that this is one piece of an overall plan, and that's what Copper Beech does so well with all their clients, is that they integrate the best tools from the best resources all the time for the best outcomes for their clients. So I love it, and I've never heard of this, so I thank you so much for the education today, and I encourage everybody to go check you out for sure. Michael, thank you so much for bringing them on the show. The only issue I have is now I feel guilty about drinking Mountain Dew with my pinky out at my club, so I'm going to I'll try to refrain from that now that you've put the guilt trip on, Darren. But this is a great podcast. Michael, again, thank you so much, and you know what? John really missed out because this was a great podcast, and you were the man today. So I appreciate it.
Well, thank you. Well, thanks for hosting as always, Eric. We appreciate it.
Oh, anytime. And the last thank you goes to the audience. Thank you so much for tuning in and listening to the Truth About Wealth podcast with John and Michael Parise. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when John and Michael come out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thank you so much for listening today. For everyone at Copper Beech Financial Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Truth About Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Copper Beech Financial Group. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
This material is for informational purposes only. Neither APFS nor its representatives provide tax, legal, or accounting advice. Please consult your own tax, legal, or accounting professional before making any decisions. Securities offered through American Portfolio Financial Services Incorporated, a member of FINRA SIPC. Investment advisory and financial planning services offered through American Portfolio Advisors Incorporated, an SEC-registered investment advisor. Copper Beech is an unaffiliated entity of APFS and APA. Any opinions expressed in this forum are not the opinion or view of American Portfolios Financial Services Incorporated, APFS, or American Portfolios Advisors Incorporated, APA, and have not been reviewed by the firm for completeness or accuracy. These opinions are subject to change at any time without notice. Any comments or postings are provided for informational purposes only and do not constitute an offer or a recommendation to buy or sell securities or other financial instruments. Readers should conduct their own review and exercise judgment prior to investing. Investments are not guaranteed, involve risk, and may result in a loss of principal. Past performance does not guarantee future results. Investments are not suitable for all types of investors.